Here's something that surprises people once they actually start digging into how self-made millionaires think. It's almost never about a genius investment, a lucky break, or some secret financial trick the rest of us never got told about. Study after study on self-made wealth keeps landing on the same answer. The real difference between people who build serious wealth and people who don't isn't intelligence. It isn't luck, and honestly, it's often not even income. It comes down to a specific way of thinking about money, time, and decisions, and it's learnable. Today I want to walk through what that actually looks like in real life. Not the vague motivational stuff, but the concrete thought patterns that separate people who build wealth from people who don't, no matter what they earn. And stay with me until the end, because the shift that matters most probably isn't the one you're expecting. Before we get into it, let's clear something up because a lot of videos on this topic get it wrong. This isn't about visualizing success or manifesting abundance or believing hard enough that money shows up. Sounds nice, sure, but it has almost nothing to do with how people actually build wealth in the real world. What we're covering here is based on patterns researchers and financial professionals keep observing over and over in people who actually built wealth from nothing. These patterns are practical. They have zero to do with positive thinking as some kind of strategy. Let's start with the biggest one, because honestly, everything else on this list traces back to it somehow. Wealthy people think in terms of assets versus liabilities. Most people think in terms of income versus expenses. Sounds like a small difference. It's not. Someone thinking in income versus expenses asks, can I afford the monthly payment? Someone thinking in assets versus liabilities asks a completely different question. Is this going to put money in my pocket over time, or take it out, regardless of whether the payment technically fits my budget? A car is a liability for most people. It costs you money every month, payments, insurance, gas, maintenance, and it loses value the whole time you're driving it. A rental property, a stake in a business, a solid investment, those are assets. They have a real shot at putting money back in your pocket down the line, through appreciation, dividends, income, whatever. Now, this doesn't mean wealthy people never buy liabilities. Of course they do. The difference is they know exactly which bucket a purchase falls into, and they're deliberately balancing the liabilities against a growing pile of assets, instead of just piling up liabilities and hoping for the best. There's an old line from personal finance circles that nails this. The poor and middle class buy liabilities they think are assets, while the wealthy buy assets, keep their liabilities low, and only add more once their asset base can actually support it. People argue endlessly about whether the house you live in counts as an asset or a liability. Some say it's an asset because it appreciates. Others say it's a liability because it costs you money every single month, no matter what. Honestly, the real answer depends on your specific numbers. But just asking that question at all, instead of assuming every big purchase is automatically smart, is the actual shift we're talking about. Second one, thinking in net worth instead of income. This trips up a lot of people because we're kind of obsessed with income as the marker of success. But someone pulling in $200,000 a year with zero savings and a pile of debt is, in a real sense, poorer than someone making $60,000 with a solid investment portfolio and no debt. Wealthy people track net worth, assets minus liabilities, as their actual scoreboard, not their paycheck. Income is just one input into that number. A big income spent entirely on lifestyle and liabilities can produce a smaller net worth than a modest income that's consistently turned into assets, and this plays out in ways you'd never guess from the outside. Someone can look successful, nice car, big house, fancy vacations, while their actual net worth sits near zero or even negative once you factor in all the debt propping that lifestyle up. Wealthy people tend not to be impressed by that. A high salary funding an equally high level of spending gives you the appearance of wealth without any of the substance. Meanwhile, someone driving a 10-year-old Honda might be sitting on a net worth several times higher than the person who looks far richer on paper. Third, time matters more than money, and wealthy people actually treat it that way. Money you can earn again. Time you spend is just gone permanently, no way to get it back. Wealthy people tend to be unusually careful about how they use their hours. because they understand time spent building skills, relationships, or income streams compounds almost exactly the way invested money does. You'll see this in small ways: paying someone else to do a task that isn't the best use of their specific skills, saying no to things that don't move them towards something meaningful, treating hours spent learning as a real investment instead of something that needs to be justified against a paycheck. This one confuses people at first, honestly, because it can look like laziness, paying someone else to mow the lawn or clean the house. But really, it's more of an ongoing calculation running in the background. Is the next hour better spent on this task, or on literally anything else I could be doing with it? For someone building a career or a business, an hour wasted on low-value work is an hour not spent on something that actually moves the needle. That opportunity cost is invisible, easy to ignore, but people who think this way treat it as very real. Fourth, a completely different relationship with risk. Most people see risk as binary, safe or risky, and safe wins by default nearly every time. Wealthy people tend to think in terms of calculated asymmetric bets, limited, clearly understood downside, with a much bigger potential upside. That's a totally different mental framework than just being reckless. A calculated risk means knowing exactly what you stand to lose, making sure that loss wouldn't wreck you, and only then moving forward if the reward actually justifies it. And here's the thing: avoiding risk entirely feels safe, but it's its own kind of long-term risk. Inflation, opportunity cost, the sheer difficulty of building real wealth without ever taking any risk at all, those work against you quietly the whole time. It helps to separate risk from uncertainty here. Uncertainty is just not knowing what's going to happen. Risk is the actual, measurable amount you stand to lose if it goes badly. Wealthy people get comfortable with uncertainty while staying genuinely careful about risk, meaning they'll try things without knowing how it turns out, as long as they've clearly limited what a bad outcome would cost them. That's why you hear investors talk about position sizing, or entrepreneurs talk about only risking what they can actually afford to lose. It's not bravado. It's a deliberate method for taking on uncertainty without exposing themselves to real life-altering risk. Fifth, failure is data, not identity. This is one of the most consistent traits you'll find across successful entrepreneurs and investors. They can separate a failed decision from a feeling of personal failure. Someone with a fixed, avoidant relationship with failure treats every setback as proof they shouldn't have tried, and that mindset tends to shrink every future decision they make. Someone with a wealth-building mindset treats a failed business or a bad investment as information. Here's what didn't work, and folds that straight into the next move. It's not that failure feels good. It doesn't. It's that the failure never becomes a permanent story they tell themselves about their own limits. There's a reason so many successful entrepreneurs have at least one big, well-documented failure sitting somewhere in their history. It's not despite that failure that they eventually made it. In a lot of cases, the lessons from that exact failure are part of what made the later success possible in the first place. The mindset difference isn't failing less than everyone else. It's pulling more usable information out of each failure and getting back into motion faster, instead of letting one setback turn into months or years of hesitation. Sixth, delayed gratification, though not the oversimplified version everyone talks about. It's not about never enjoying your money right now. It's about being honest with yourself about which spending genuinely improves your life today and which spending is really just patching an emotional gap in the moment at the expense of something bigger later. Wealthy people absolutely spend money on things they care about. What they're better at is telling the difference between spending worth trading future wealth for and spending that's really just impulse wearing a nicer outfit, the kind that disappears almost instantly and leaves you with one less dollar to compound into. Something real. There's that old marshmallow experiment people love bringing up. Kids who could hold off eating one marshmallow now in exchange for two later tended to do better across a bunch of measures years down the line. Whatever you think of that particular study, the underlying idea shows up consistently in how wealthy people actually handle money. A real, practiced ability to sit with not having something right now in exchange for something meaningfully better later, instead of needing every craving satisfied the second it shows up. Seventh, a bias toward ownership over pure consumption. Most spending is consumption. You pay, you get a good or service done. Wealthy people are constantly on the lookout for ways to turn spending into ownership instead. Instead of just consuming entertainment, some people go build a platform. Instead of just paying for a service, some look for a way to eventually own a piece of the business behind it. That doesn't mean every single purchase needs to somehow become an investment. That's neither realistic nor the point. It just means that when a real opportunity for ownership shows up, wealthy people tend to notice it and actually take it. Instead of defaulting into being a customer every single time, you see this in something as simple as buying versus renting, or building a skill into a freelance business instead of only ever selling that skill as someone's employee. Neither path is automatically wrong. Renting makes total sense plenty of the time, and being an employee is a completely valid road to wealth too. The mindset difference is just in habitually asking the ownership question at all, instead of sliding into the consumption path without ever considering whether ownership was even on the table. Eighth, treating financial education as something ongoing, not a box you check once. For most people, financial education stops somewhere around learn to budget, if it even gets that far. Wealthy people tend to keep learning about investing, taxes, business, markets for their whole life, because they treat that knowledge as a direct lever on their future wealth, not some abstract subject you studied once in school. You don't need a degree for this. It shows up as reading, listening to the right content, asking people who actually know things specific questions, staying genuinely curious about how money works instead of assuming you've learned enough and can stop paying attention. Even 15 minutes a week spent actually learning something new compounds into real expertise over a few years. Kind of the same way small, consistent contributions compound into real money over that same stretch. Ninth, surrounding yourself on purpose with people who think about money the way you're trying to. Most people absorb their financial habits passively from whoever happens to be around them. There's that idea floating around that you become an average of the 5 people you spend the most time with, and it holds up especially well when it comes to money specifically. If everyone around you treats a raise as an excuse to upgrade their lifestyle, that becomes your normal too, without you ever consciously choosing it. Wealthy people tend to be intentional about who they spend time with, mentors, communities, friends, where thinking long-term and making deliberate financial decisions is just the default, not the exception. They get how much your environment shapes your behavior, often more than willpower ever could on its own. And the 10th one, thinking in decades, not months. Almost every financial decision looks completely different depending on the time frame you're judging it against. A market downturn looks terrifying over 6 months and looks like a minor blip over 20 years. A side business that isn't profitable in year 1 looks like a failure on a 12-month clock and looks like necessary groundwork on a 5-year clock. Wealthy people default to judging big decisions against a much longer time frame than most people naturally use, which lets them stay calm through short-term chaos that would send someone thinking in months straight into panic mode, abandoning a strategy that was actually working fine. This one's probably the hardest to actually internalize, because our day-to-day experience with money is almost entirely short-term. This week's paycheck, this month's bills, this year's expenses. Training yourself to judge a decision against a 10 or 20-year window takes real, repeated practice, and it usually means sitting with short-term discomfort that feels bad in the moment, purely because the long-term picture makes it worth it. That's exactly why building wealth looks so boring from the outside, week to week. The results only become visible once enough of those boring weeks have quietly stacked up over years. Now, these 10 aren't 10 separate, unrelated ideas floating on their own. They feed into each other, and honestly, that's where a lot of the actual power comes from. Thinking in assets versus liabilities naturally leads you toward tracking net worth instead of income, since net worth is really just that same distinction applied to your whole financial life. Treating time as scarce naturally supports thinking in decades. Both require caring about long-term outcomes over immediate comfort. Viewing failure as data supports taking calculated risks, because without that reframe, the fear of failing would make any real risk feel unbearable. And surrounding yourself with people who think this way makes every other shift so much easier to actually stick with, because you're not swimming upstream against everyone else's default habits every single day. That's exactly why this whole thing isn't really about any one trick or decision. It's an interconnected way of thinking that, once it actually sinks in, changes the pattern of small decisions you make every day. And that's ultimately where most wealth gets built or lost. Not in one dramatic moment. In thousands of small compounding choices made a little differently over years. No single shift on this list would change someone's trajectory much on its own. It's the combination, reinforcing itself over a long stretch of time, that eventually produces a genuinely different outcome than the one most people end up with by default. Let's clear up a common misunderstanding before we get into how to actually use any of this. A lot of people hear millionaire mindset and picture someone who never spends money on anything fun, living some brutally restrictive life, obsessing over every dollar. That's just not accurate. Plenty of wealthy people spend generously on stuff they actually value. This isn't about restriction for its own sake. It's about intention. Spending that comes from a real decision aligned with your values and your goals, versus spending that's just reactive, driven by impulse or boredom or keeping up with someone else, with basically no thought behind it, and it's worth being upfront. Mindset alone won't guarantee you get rich. Someone can have all 10 of these shifts locked in and still run into real structural barriers, bad luck, or circumstances completely outside their control. This isn't a magic guarantee. What it does is stack the odds heavily in your favor, and it means that when a real opportunity actually shows up, you're positioned to recognize it and act, instead of letting it slip by because your thinking wasn't set up to notice it in the first place. Okay, let's talk about actually applying this, starting now, instead of just nodding along and forgetting the whole thing by tomorrow. This week, calculate your actual net worth, even if the number makes you wince a little. List out everything you own that has real value, savings, investments, property, whatever, and subtract every liability, all your debt included. That number becomes your new scoreboard, replacing income as the thing you actually measure your progress against. A lot of people are genuinely shocked the first time they do this honestly, in either direction, and that shock alone tends to be enough to make them start taking their decisions more seriously going forward. Redo this every few months so you can actually watch it move, instead of only ever seeing one frozen snapshot. Next, go back through last month's spending and sort each expense into asset building or straight consumption. This isn't about guilt. Plenty of consumption is completely fine and worth doing. It's about awareness. Just seeing the actual ratio between what you're building and what you're consuming often reveals a pattern you had no idea was there. Then pick one thing you genuinely don't understand well: investing, taxes, real estate, business basics, whatever's most relevant to you, and commit to 15 minutes a week learning about it. That tiny habit compounds into a real base of knowledge over a year, something most people never build simply because they never started small enough to actually stick with it. Take an honest look. 2. At the 5 people you spend the most time with, and ask yourself whether their money habits and conversations are pulling you toward this way of thinking or quietly pulling you away from it. You don't need to cut anyone out. Maybe it just means finding 1 or 2 new relationships or communities where these ideas actually get talked about, so you've got some real counterbalance to whatever financial culture already surrounds you. And finally, next time you're facing a real financial decision, pause and ask how it would look if you judged it against a 10-year window instead of your gut reaction right now. This one habit, more than almost anything else here, tends to filter out a huge chunk of decisions that feel urgent and important in the moment, but genuinely don't matter much against the actual, much longer arc of building wealth. So let's recap. The millionaire mindset comes down to 10 learnable shifts: thinking in assets versus liabilities, tracking net worth instead of income, valuing time over money, taking calculated risks instead of avoiding all risk, treating failure as data instead of identity, practicing real delayed gratification, favoring ownership over pure consumption, treating financial education as ongoing, deliberately choosing who you surround yourself with, and consistently judging decisions against decades instead of months. Here's the thing to remember. None of these 10 require you to already have money. Every single one is a way of thinking you can start applying with whatever you're earning right now, starting with your very next decision. Wealth isn't really the cause of this mindset. It's usually the result of it, built slowly and consistently over years of small decisions made a little differently than they otherwise would have been. Whichever of these 10 hits you the hardest right now is probably the right place to actually start, rather than trying to overhaul all 10 at once. If this gave you a new way to think about your own money, hit like and subscribe because we put out practical, real-world money content just like this every week. Drop a comment and tell me, which of these 10 do you already do naturally, and which one genuinely caught you off guard? Next video, we're getting into how to actually build your first real asset, step by step, even starting from absolute zero. Hit that bell so you don't miss it. See you in the next one.